Well, why don't we get started here? I have a couple words I need to say up front. First of all, I am super excited to be joined by the renowned and thematic guru Cathie Wood, the founder, CEO, and CIO of ARK. Cathie, thanks so much for joining us.
My pleasure, Sean. Very happy to be here.
So we're going to talk today about the macroeconomic landscape. We're going to talk about what is thematic and Cathie's view on innovation themes and convergence. We're going to talk about some individual securities. So a couple of things I would say to everybody in advance. If you have any questions during this, please don't hesitate to put those questions into our Q&A at the bottom of this session. Um, Please note, if you are on this webinar or registered for it, this will be recorded and posted on YCharts YouTube channel. And also it will be emailed out to all registrants tomorrow. And the final thing I'd say is please keep in mind that the content of this webinar is meant for educational purposes only. And YCharts is not acting as an advising party regarding client funds in any way, shape, or form. So that's the formality.
All right.
Cathie, tell us a little bit about yourself. From your bio, you've done everything from being a macroeconomist to a thematic lead investor to now running your own business. I guess my big question to you would be, what has been that common thread that has woven throughout your career?
I guess the biggest one is innovation, probably because when I got into equity research in the early 80s, Sig Segalis, the chief investment officer of Janus and Associates at the time, said, okay, we think you'd be, I was doing economics at the time. And he said, yeah, we'll give you a shot at equity research, but you cannot take stocks from any other analyst. You have to find your own. And so what happened because of that, serendipitously, was I got what I was calling back then the fall through the crack stocks. In other words, they didn't fit neatly into any sector, industry, or sub-industry. And the big example there was what we called at the time database publishing. Now, the tech analyst didn't want it because it said it had publishing. And the publishing analyst didn't want it because it had tech. And so I said it's a fall through the crack stocks, but that was the wrong term for it. It was a convergent stock, the very early days of convergences between and among technologies and really permeating every sector.
Wow. Okay. So awesome. And I have my own story. I started my career as a software engineer with a finance background, and it just led to seeing the power of innovation and the power that technology could provide. You mentioned a key word, which was innovation. And I'll tell you, for anybody who's not already reading it, ARK puts out some fantastic thought pieces. The Cathie, I'm especially familiar with the 2023 and 2024 big ideas, and I know this Platforms of Innovation put out by a member of your team, Brett Winton.
Yep,
Um,
chief futurist.
so tell us about this. First of all, I've always been fascinated with you because research leads to themes and themes lead to investments. And it's very easy for anybody who follows you to see those direct ties all the way through from the big ideas to the themes to how you configure your funds. But can you walk us through maybe why do you publish these phenomenal pieces, and maybe talk us through these five themes that you've got in your works for 2024?
Sure. Well, one of the reasons we publish is because our one of our values and missions is to educate. And we're filling what I believe is an unmet need out there. As the markets have gone more passive in their approaches, or benchmark sensitive, what they're doing is focusing more on what has happened than what is going to happen. Not that they're dismissing what's going to happen, but if you've aligned a portfolio with a benchmark like the S&P 500 or the NASDAQ, of course, the stocks at the top of those benchmarks are there because of past performance. And since 2020, what we've seen is the tech and telecom bust, and even more so after 0809, there's been risk aversion in the market, business risk, career risk. And where did the traditional asset management firms feel comfortable? They felt comfortable not straying far from their benchmarks. And it's very interesting looking through some statistics recently. We know that the S&P 500 and NASDAQ are converging. The Mag 6 are and other common holdings are increasing the overlap quite significantly. And I think the S&P, for example, the Mag 6, now that Tesla's been kicked out, the Mag 6, it's something like 27% of the S&P 500. These are very rough. And maybe 35 or a little more percent of the NASDAQ 100. But large cap growth managers are 45% overweight in those stocks. Again, they're looking at the benchmark and say, okay, I'm going to overweight these because I think they're a trend in motion, or the momentum is with them. And that's one way it's been successful in certain markets. But I remember times when, and they are quite a long time ago, but I think we've swung the pendulum so far towards benchmarks that more of the surprises, upside surprises in the future, are going to be in non-benchmark stocks. And so we are providing a differentiated exposure to innovation, but we're doing it because we're filling an unmet need out there. Most of our stocks are not in benchmarks. Again, we're reaching further into the future than most are. And so we'll be very early in some stocks. NVIDIA is 1. We got in at 4 on this stock split. And we rode it basically 100-fold in various portfolios. And we pulled it out of our flagship. But now we're on to the next AI plays. Everyone understands NVIDIA now, and it has done amazing things for the space. But we think they're neglecting and not thinking or researching enough how AI is going to course its way through the economy.
Got it. Can you give us maybe? I think everybody's familiar with blockchain.
Yes, and Sean,
and maybe go ahead.
Yeah. You asked me to name the 5 platforms, so definitely let me do that. And I'm sorry I didn't. So robotics. Now, these are the 5 major innovation platforms evolving today, and I can tell you how we define a major innovation platform, but I'll name them first. Robotics, energy storage, artificial intelligence, blockchain technology, and multi-omics sequencing. And these are 5 major platforms, and we characterize an innovation platform, a disruptive innovation platform, in 3 ways. 1, it follows a learning curve, which is expressed through cost declines. And as costs go down, the access to these technologies increases over time across sectors. So
Mhm.
they can end up as mass market opportunities. Two, I actually just gave you it, cross sector. We must think this idea is big enough to scale across sectors, meaningful
Mhm.
enough. And then three, these platforms become launching pads for more innovation. So in the
Mhm.
case of multi-omic sequencing, for example, we would not have CRISPR gene editing, really correcting or reprogramming our genes and curing disease. This is actually occurring today, unless we had sequencing first. We needed to first be able to identify, the DNA and the 6 billion bits of code in our genomes. So that's just one example.
Got it. And the everybody's familiar with the Venn diagrams, and where they overlap is where things get interesting. Obviously, you're saying here when there is convergence in these overlaps is where you see a force multiplier on innovation and investment returns.
Yes. Now, one of the things that we encourage our companies to do is to invest aggressively in these platforms because some of them are winner take most. So invest now, forego short-term profitability,
Mhm.
and be at the front of the line. Uh, and so you'll see, and it has been a problem in a rising rate environment for our companies, particularly in the multi-omic space. Um, but the breakthroughs that we're beginning to see in healthcare are phenomenal. Curing disease, sickle cell disease, that there was not a cure before last year approved by the FDA. There was no cure at all. It was just treating symptoms. Same thing with beta thalassemia. Beta thalassemia is another blood disease. And the first person in CRISPR therapeutics trials, starting about 4 years ago, nearly 4 years ago, he used to have to go to the emergency room 17 times per year to get a blood transfusion on an emergency basis. He hasn't had to do that once, and all they did was that one edit. So what is a little frustrating in these macro-driven markets
Mhm.
is, these companies that are going to extend people's lives, actually cure the diseases they have, and they're starting to do trials in diabetes and cancer and so forth. The time horizon of most investors is today. They want their profits today, their dividends today, their share repurchases today. We don't offer that, but what we do offer is exponential growth opportunities and a low correlation of returns with other growth managers. In fact, as people look at ARK and analyze it from a factor point of view, it's very interesting to learn that ARK is not a momentum investor. Our portfolios do not act like momentum portfolios until they do. And when macros change, and we think they will, um, truth will win out.
Got it. So I'm going to skip ahead because you did mention the macroeconomic landscape. And I know you've been politely outspoken that you're not sure Jerome Powell and his peers are necessarily seeing the looming problem statement in the right way. Can you share kind of your views on interest rates, inflation, deflation, and actually how this ties back, like you were mentioning, how this ties back to small companies innovating?
Yeah, it's very interesting what's going on right now. Um, it feels very much like another confusing period that played out very well for the stock market and for innovation generally. It was in the mid 80s. And in the mid 80s, the dollar was rising against all expectations. We had twin deficits, trade and budget, and nobody thought those would ever come down. And so most people thought the dollar would go down, and it didn't. It went up. Why did it go up? Monetary policy was so tight here, especially relative to the rest of the world. Now, the dollar is going up, and if you look at it over a very long period of time, it is moving into the top third of its very long-term history. Let's say going back to the 70s, right after we closed the gold window. And I think that is causing some deflationary undercurrents. If you peel the onion, I know everybody looks at employment and GDP, and that's fine. But if you look underneath, what you will find is real pain and suffering in the lower income households and in small businesses, which are the biggest job creators. If you look at the NFIB, the National Federation of Independent Business, their optimism or sentiment is down where it was at the bottom in 08, 09. We're seeing bankruptcies multiply now. And of course, you've got the big companies out there that are gaining share and get a lot of the publicity, whereas a lot of these smaller companies just go poof. We've seen a number of them in the genomic space, but small businesses are hurting. And I don't know what the aha moment is going to be, but it is coming, much like it did in 80, 85, 86. It may come from outside the US. China is in a world of hurt, and it is trying to export itself out of that conundrum. And according to the broadest gauge of inflation in China, it has never been this long in a period of deflation before. So it's exporting deflation. Anyone who knows Shein and Temu knows that China's exporting deflation, and it's not just in consumer-facing categories. Mm-hmm. We're also seeing some real warning signals out there, and I'm very happy that Mohamed El-Erian mentioned them today on Bloomberg, because they're right on. Currencies around the world are beginning to implode. You've got the Nigerian naira down 50% in the last 9 months. You've got, and it was down more, the Egyptian pound just devalued 40% in early March. The Indonesian rupiah, you're seeing the Japanese yen, even though they're talking a little like as though they will raise interest rates or continue to raise them slightly, the yen has broken down. And what's very interesting about that, and this does take me back to my days in the 80s, one of the international strategists that we used at the time, who's still around, Charles Gov, he used to say, whenever the yen is breaking down, it means that there's something bad going on out there in the industrial world. Mm-hmm. And we think that's true. You look at all the industrial indicators here in the United States. Fastenal just reported its daily sales, and they're really suffering. And again, that's emblematic probably of what's going on here in the United States more than abroad, because it's primarily based here in the United States. And that's, nuts and bolts throughout the economy. So I think there's a lot more pain. Mm-hmm. I think the dollar is symptomatic of it. And there's one other that is. And believe me, I know what the arguments against this are. And some of them have surfaced in recent days. Some people are saying, well, look, the gold price has broken out to the high side. And I said, yes, that is true. But is that a bet on inflation or a flight to safety? And if you look at what's going on in the emerging markets with their currencies, people are running out of them. There's capital flight, including from China, I believe. Can't prove it. But I think that's partly what's going on. And one of the the confirmations of that is a ratio of the metals price to the gold price. If you use the CRB metals price to the gold, you'll see it is at it's as low as it's been. I mean, we're down at 08, 09 levels. What does that tell you? It tells you the pricing power or the purchasing power of gold has gone up relative to metals. Now, some metals are going up again, copper, but I think there's a lot of algorithmic and arbitraging going on. Many people using gold as their lead. Let's see what happens here. Let's see what happens.
So, with all this confusion and with the market trying to figure out inflation versus deflation, and as you're explaining, small companies need capital. And when rates are rising, capital acquisition is difficult, and it's tough to come up with that sequencing that may make a big difference in the lives of a few individuals. When you mix together all this confusion and the fact that small companies to innovate need capital, how do you think about the right timing for you and your funds to make an investment given uncertainty that could go one way or another?
Well, we post our trades every day, and we disclose our holdings every day. So you can see stylistically what we do. When we're initiating a position, we're not going to go in with a full position. We're going to start at 50 basis points and build and look for opportunities, which are usually associated with controversy. Disruptive innovation is controversial. So you've got the big guys out there. This had happened for a long time in the auto industry. GM, Ford, VW, all of them basically wanted to swat Tesla away like a little, flea in the early days, right? Because if this were going to develop into a market, they were going to control the market. After all, they were the big three at the time. And what has happened there proves out that there is a completely different DNA in companies trying to change the way the world works than in companies that have grown up on how the world does work now. And so we average into positions, and we usually average down into positions. And it's considered, again, it's probably why we're not considered a momentum investor. We're taking advantage of controversy. I'll give you a good example. Coinbase, oh my gosh. Last year, was it at this time? Yes. Last year at this time, I believe the SEC served it with a Wells notice. Now, in my history, or in the business, anytime a financial firm gets served a Wells notice, run for the hills. But instead, we bought because we saw how the judicial branch was treating crypto. It basically was saying, SEC, you are out of line. And so we were looking very carefully at that, and we bought into it. That stock, from its low to its recent high, was up tenfold in 1 year. And we get a lot of opportunities like that. I mean, in a nervous market, I'm sure many of our clients say we get too many of those opportunities. Right now, once again, just like at the early stage of COVID and in 22, the market algorithms, I'm going to say, is going after companies with who are not profitable and maybe have 2 to 3 years a runway of cash, and that's all. So nobody cares what they're doing. An algorithm doesn't care what these companies are doing. But we know what they're doing and how important they are to, and will be, to creating the cures in disease that we're talking about. They're important in the research step in academia. They're important to pharmaceutical and biotech companies. So we're willing to put up with short-term pain, no matter how controversial it is, if we believe a company is well-positioned and that it will begin, and investors will begin to reap rewards within the next 5 years.
Very interesting. And and this is a picture that I took from your big ideas and your other research report, which I found fascinating, and talk about, the detailed top down and bottoms up analysis that you and your team did to create these things. But um, eh, this basically is showing the effect on GDP of some very transformative technologies. And the ones that are in kind of the brighter colors by your team are tied to the themes that you are very interested in. Can you talk a little bit about this picture?
Sure. And I'm not sure if you have another picture, but doing this kind of analysis, it's really based on the cost declines, the technologies themselves, and the kinds of productivity gains they will unlock. Innovation is all about productivity, and productivity increases accelerate GDP growth, and is kind of a win-win. Many people think robotics is terrible for the labor force and employment and so forth, but it's not. Technology is a net job creator over time. Sure, there are going to be short-term displacements, but over time, and not a long period of time, technology is a net job creator. So as productivity goes up, the productivity, the people who are harnessing these technologies have an opportunity for their wages to go up as well. So it's a win-win. And so this chart is saying that artificial intelligence is going to unlock more productivity during the next few years, and here it's through 2030,
Mm-hmm.
than almost all of these other major breakthroughs combined. And now the question we have to answer is, okay, that's great. Who's going to make money? How much of this is going to be commoditized? Because AI training costs are dropping 75% per year. And AI inference costs, so people like you and me
Mm-hmm.
using ChatGPT, for example, are dropping 85 to 90% per year. We've never seen anything like this. And so the question is it the large language model companies, the foundation model companies like OpenAI and Anthropic? And we have both of them in our venture fund now. We think so because as we have monitored their progress, they are it's in a winner take most. We have a winner take most moment here, I think. People are going to use the foundation model that is going to be for them the most performant. Now, there is a question about the open source models. Meta Platforms has one. So does Twitter or X, Grok. We want to see how those progress, and we'll see if they give the other foundation models a run for their money.
Mm-hmm.
We actually think most of the benefits will be harnessed by the users of this technology. They will be able to salvage margins if we're right and pricing pressure continues to increase to the downside. I realize we've had a few CPIs that have that are stuck now in the 3.5% range. We think one of the things that's going on there, first of all, big lags. We know rents are coming down in many places around the country, but also I am sure that some companies they're seeing unit growth disappoint, and many companies are seeing unit growth disappoint, and they're trying to make that up, at least from a margin point of view, by increasing their prices. We don't think that will be successful. We think that's going to exacerbate the problem, and that inflation will unwind, will continue to unwind, and that we will actually end up in deflation territory. For good reasons, innovation, inherently deflationary,
Mm-hmm.
and for bad reasons, cyclical pain, and obsolescence caused by disruptive innovation.
Yeah, I was I just will validate your well-researched excitement about AI. I saw a friend who's a super capable software engineer. I saw him create an app in 2 hours
Mm-hmm.
to publish on the App Store. And I'm just telling you from my past experience in traditional software development, this would have taken at least a month and a half. And he did it in 2 hours, leveraging some AI services, and it was mind blowing. And I just looked and said, if that can have that kind of force multiplier effect on software development, imagine what it can do in every other space available.
Yeah, in the span of just a few months, coders' productivity increased by more than twofold. That
Mm-hmm.
was just in a few months. One of our analysts created a website in an afternoon. That
Mm-hmm.
also used to take whole companies were built around trying to do that in the day, and some still exist.
Yeah. Are you thinking of your big ideas for 2025 potentially being written completely by AI?
We're trying to do as much with AI as possible. We just actually had a demo from Palantir,
Yeah.
uh, and because we're experimenting with Palantir, and it was astonishing. Some of the reports that are routine reports for us that pass through many hands, they did it. I mean, sure, a human being has to check it out because there are hallucinations, and sometimes it's wrong, especially if it's not loaded correctly. But it's astonishing what they're able to do.
That is amazing. So, Cathie, you and I talked and agreed we're not looking to create a commercial for ARK's funds, but wanted to tie together how themes translate into funds
Mhm.
and make that connection for our audience. So, um, uh, you know, the ARK Innovation Fund that is shown here tried to lay out in this donut chart the various holdings. As we think about those themes that you mentioned in the five overlapping circles, is ARK's purpose to try to capture a basket of all of those themes, or is it focused on just a couple of the five themes?
No, so this is ARKK, and I like the way you've done that with the orange K. This is exposure to all of the platforms.
Okay.
Some are we've been taking profits. For example, last year when Tesla was hitting $400, we were taking profits and putting them into other names that were getting hurt. Square, Roku, for example, Coinbase. I mentioned that one at the outset. But these are a sampling of really all of the technologies. If you had put in the other ones as well,
Mhm.
we would have had exposure to all of them.
Okay, got it. And so I know advisors, and we have a lot of advisors on this call right now. Advisors get calls from their clients every day saying, should I get into Tesla? Um, how should I invest in Roku, et cetera? And I think advisors, many say, well, you can either invest with a very small portion of your sleeve and go ahead and put it into Bitcoin or Coinbase or whatever you want, because the volatility is too high. And I want to make sure you're aware of the risk return trade-offs. Did a quick picture here, which is just a simple scatter plot showing 5-year standard deviations versus 5-year returns. And I think what this picture just said clearly to me is the value of diversification and the value of diversification into a fund like ARK. If you want a taste for innovation, but you don't want that single security risk, you can get a solid return that gives you a taste for the innovative returns, but a standard deviation that's way lower.
Right.
And is that the way we should look at all of your funds?
Yes, it is. The standard deviation, of course, will be higher than most funds out there. What we often say, and we have a paper, it's either on ARK-Invest or ARK-Funds, not quite sure which, where we show if you were to have given ARK a slice of out of your, just say core, you have core growth, core value, core emerging markets, and you gave ARK a slice out of that, 5, 10, or 15% of the, what a holding in ARK would do, since its correlations are pretty low, believe it or not, relative to other equity strategies, it would, over a 5-year rolling basis, and these are monthly returns, over a 5-year rolling basis, you would have increased your returns per unit of risk. Now, the other thing that we're doing, and that I think is really important to do, is because of the volatility, to rebalance after we've outperformed, say, 15% relative to the rest of the portfolios, rebalance back down to whatever the original weights are, or the opposite, if we go down 15% relative to the rest of the portfolios, the other way around. We've been in, and this is a 5-year, I think these are 5-year numbers. Yes. This has been one hell of a market, because now there's definitely endpoint sensitivity. We couldn't do anything wrong in 2020. That's dropping out, right? Our portfolios were up. Well, the flagship was from the trough in March or April to the following February, the flagship was up 360%, right? So we're losing some of those numbers. But nonetheless, the exercise that I just described, as we published, would have delivered, sure, that this is diversification, you see that here, but it would have increased returns per unit of risk. So we haven't put out the rebalancing one. There are some compliance issues and so forth, so just want to be careful with that.
Okay. So can we talk about the next generation internet fund, ARKW? Some interesting things are in the upper right. Exposure to Coinbase, and also you've got a sub-advisor, ARK 21 shares Bitcoin ETF. Can you talk a little bit about this fund, and also maybe your views on how should people be looking at Bitcoin? Is it an inflation hedge, or is it 21st century gold? How should advisors be thinking about it?
Sure. Well, you can see from here, the top 3 holdings really are in the digital asset space, the digital wallet space, an exchange, and of course, Bitcoin itself. So the history here is, this is the only fund, at least as of now, that can hold Bitcoin. GBTC was, when we first put it in our portfolios in 2015, Bitcoin was only $250. Today it's $62,000. And yet our confidence remains so high that it is the second largest position in the fund. The Bitcoin itself was the question: how high is high for Bitcoin? Because we do have a price expectation out there for 2030, and from $62,000 today, we believe, and we're leaning towards our bull case. Our base case is roughly $650,000. Our bull case is 1.5 million. Why? Three reasons. Bitcoin is three different movements. It is a technology for sure. It is a global rules-based digital monetary system, and it is a new asset class. It is the most important member of a new asset class. It's a very big idea. And so we think it has miles to go, with the SEC, kicking and dragging its feet, approving the spot Bitcoin ETFs, because the judicial system basically said, that is not your jurisdiction. What you're suing this company, that company, and the other company for is not under your jurisdiction. You're out of line. The judicial branch is coming our way, and the legislative branch is coming our way. So, and of course, I just described a situation where emerging markets, think about the poor people in those emerging markets losing most of their purchasing power and wealth. They are going to try and save themselves. And if they have an internet connection, they should be able to have access to Bitcoin. And I think that's partly why some of these currencies are starting to devalue. Coinbase basically lost a lot of competition last year. FTX went under. And Coinbase, despite the to and fro with the SEC, is the most regulatory compliant exchange in the world. And it is moving abroad and gaining terrific traction abroad. It has 100 million users right now, but those are proliferating quite quickly. And then Block is also, most people know it for Square and Cash App. Square for merchants, Cash App for consumers. We think those are merging. That's a two-sided platform that's going to become a positive feedback loop and disintermediate the banking system. But it is also surreptitiously entering emerging markets through Bitcoin. Its sole focus in terms of digital wallets is Bitcoin, and enabling merchants and really rescuing consumers in the rest of the world from their own depreciating currencies. So that's a big part of this fund.
Yeah. And it's interesting to hear you weave the same words through your narrative, like winner take most, convergence, launching pad. We can see as you profile some of these securities in here, and you mentioned three pieces to Coinbase. That's what I really like about what you and your team does. It's all very consistent with the themes that you've researched.
Yes, absolutely, without a doubt, without a doubt.
So last one of your funds I just wanted to have you spend a few minutes on was the autonomous tech and robotics ETF, the ARKQ. We're going to spend time in one slide talking specifically about Tesla. So I want to stay away from that and some of the overlaps. I did want to talk to you about just general themes you've got around robotics, and also ask the question of when you talk about autonomous tech, we're solving a really hard problem now called how do I get around the streets of Midtown Manhattan without a human driver? How far off are we for solving what seems like a little bit of an easier problem, which is how do we fly autonomously in all this open air that we've got around us?
Yeah, it's great question, Sean. Okay, so one of the companies in our venture fund is Zipline. Zipline has traveled 75 million miles autonomously, delivering medical care, medical products, 8 pounds or less, in Rwanda. That's where it, and it has cut the mortality of women giving birth by nearly half, because it's been able to get the right medical medicine and medical equipment there. It has signed a big deal with Walmart, not with Amazon, and I believe Walmart will launch within the next I'm going to say 2 to 3 years, a national drone delivery service in all of the United States. I think this is the way Walmart might leapfrog Amazon. And so, Amazon's part of the Mag 6. You
Mhm.
don't see that in our portfolios because we think it's a mature company. Certainly, on a top line basis, for years, it grew in the 20 to 30% range. It's now low double digits. And we think that social commerce and maybe Walmart with its drone technology is going to take more share. It's got AWS, of course, with good competition. It's a good business, but I think Microsoft and Google are becoming more ferocious in their competition. So we're not in a name like that, but we are in. Well, Kratos is one of those names. It's more for the defense sector, doing amazing things. And I think what we love about Kratos and AirVenture, which is also here, is while they're mostly defense oriented, they are collecting data about the skies that is proprietary, and they're collecting it not just on their own, but the key to AI projects is to make sure you gather is proprietary data and make sure you gather it, aggregate it, clean it up, and then you can harness it. So we think they have a unique data asset. Well, most of these companies do. As a result, you'll see. So autonomous is certainly Tesla, Kratos, AirVenture. Trimble as well does a lot with GPS in agriculture and elsewhere. You see robotics also. Now, UiPath is up near the top.
Mhm.
Now, technically, what people used to call it was a robotic process automation company. It is the first company to have thought about this idea even before AI was a thing, in the way we're talking about it now, to get big companies together and have them collaborate on best practices for very mundane administrative tasks. Paper pushing, a big one among them, right? The most interesting thing about that proprietary data is, okay, UiPath has that data now. Those companies gave them the
Mhm.
data because it wasn't considered IP to them. The only way it became IP is because it needed to be aggregated into a best practices. So now UiPath is using foundation models put out there. They're using Mistral, is a French large language model, Llama 2. So they're going more the open source route. And then they're putting on top building their own specialized AI models with this proprietary data. So it's very interesting there. Teradyne is robotics because they bought United Robotics. It was
Mhm.
a Danish company. And I don't think people know about Teradyne in that way. It's also a play on semiconductors,
Mhm.
semiconductor testing equipment. So, those are some of the robotics plays. Of course,
Yeah.
Iridium, Archer is drones in the sky as well. Iridium
Yeah.
is satellite technology. So, space,
Yeah.
lots of exciting companies there as well.
Yeah. So a great taste in this fund for, robotics and automation. So understood. And while you were talking about these three funds, which we profiled so that we could see how themes run through, in the category of there's things you like and there's things you really like.
Mhm.
Noticed across ARKK, just did a quick search in our software of holdings for these funds, and you do an amazing job as a company of being very transparent in your holdings. We also hold holdings not as on a daily basis as much, but this for ARK and ARKW and ARKQ, there were three of the securities that appeared in all three of those funds.
Yes.
We're going to talk in one slide about Tesla, and you just mentioned UiPath. Tell us about Unity and why you love Unity.
Yes. So Unity, there are two major game engines out there. One is Unity, and it is on mobile platforms. So if you have an iPad and you want to design something, you can use Unity's tools on an iPad to design something very quickly and modify it. So when it comes to the mobile space, and it's got a gaming heritage, right? And in fact, most of its engine use is for gaming, meaning rendering the games, particularly those on mobile, and building them very quickly and creatively, enabling the game designers. So this is collapsing the time between design and production, right? Because very easy to modify. So that's in gaming, but Unity under interim CEO Jim Whitehurst. I've known Jim since the early 2000s. He was the CEO of Red Hat, where we had a big holding for years. IBM bought Red Hat. And I watched him take that open source software and build a really important business with it, using certification as the way to do it. He, given his vast experience with other industries, he is starting to see applications for Unity's game engines in many other industries. Any industry where design is necessary, luxury fashion goods, for example. And again, collapsing the time between design and production and getting the designer to become a more important part of an iterative process is what Unity is going to enable. And because the other game engine is owned by Epic,
Mm-hmm.
so UEFN is the name of that game engine.
Mm-hmm.
That tends to be definitely more game centric and console or PC specific. Whereas Unity is still in the game world, especially the mobile game world dominates it,
Mm-hmm.
but is moving into all of these other worlds that are going to bring designers in and help them increase their productivity. And of course, AI is a huge part of enabling it, according to Unity.
Awesome. Well, thank you. And again, you can like something and you can really like something, and there's three that your team seems to really like. I want to just take a moment in our conclusion and talk a little bit. Go ahead, Cathie.
I'd just say one thing about this.
Yep.
Many times you'll hear us talk about stocks, and you're hearing topics from us or ideas that are different from how they're covered normally.
Mm-hmm.
That is one of our value adds. And many times, if you've got traditional analysts analyzing a company all the same way, Tesla is a great example as a car company, they're going to miss it because it's a robot company, an AI company, of course, an energy storage company. It will have SaaS-like margins as autonomous mobility takes off, and we think it will get the lion's share of that opportunity.
Yeah, great segue into Tesla. And I wanted to conclude with this in the next couple of minutes, Cathie. So this chart, two pieces. The top shows the revenue growth of Tesla over the last 5 years. And the red line at the top shows the net income increase over the last 5 years. The bottom is the total return over that same period of time. So your thesis is Tesla's not just cool. Tesla is a multiple definition of what a company is, and you just rattled off what a few of those are. and it is poised to be an incredibly profitable company. And it also, for autonomous driving, it's got the largest AI database of uh,
Of compared,
everything.
yeah, no one, all of the other potential players combined um, have a fraction of the data that Tesla has. And what that means is it's not about the totality of the data. It is about the corner cases that Tesla has that nobody else has. Blue stop signs in some country. I didn't even know there was a thing.
Yep.
Uh, and it also now is the first company to really use generative AI holistically. I think the reason FSD has improved so much is it has taken away some of the crutches. Very early on, it took away LiDAR and called
Mhm.
it a crutch. Do you remember when you first got your driver's lesson or you were learning for your driver's license? You remember how many things you had to measure,
Mhm.
remember
Yep.
and then when you got behind the wheel, very quickly, not it didn't take us too long to figure out, okay, there are a few things I really have to focus on. And all of those other things, sure, they can be back in my mind, but I will bring them up when I need them. Uh, so this is the same thing that Tesla is doing. It's adapting to this autonomous driving opportunity with breakthroughs in AI.
Mhm.
Uh, uh, in a way that we think we will see autonomous mobility. Uh, uh, Elon's been saying this year for the past 5 years, so
Mhm.
less
Mhm.
credibility there than perhaps. But
Yeah.
you've driven a car with FSD 12.3, 12.3, you will see a step function improvement. Still
Mhm.
not perfect, but is getting very close to being better than a human driver.
Yeah. And Elon announced yesterday a 10% headcount reduction. Um, should I look at that in the fact that in the long term, on their own, they're going to reach their profitability expansion, but there's the near-term pressure of public markets, which means you need to accelerate some of that margin expansion now?
I think no, he goes through this process to upgrade the talent.
Mhm.
And he's just the battery, Drew, his battery executive,
Mhm.
just left yesterday or announced that he was retiring. He was with Elon for 18 years.
Mhm.
That's very unusual. Most burn out in 3, 4, or 5 years. And some return after they don't find another company that's as challenging a project as Tesla. So I think this is part of his strategy, and he hadn't done one of these in quite some time.
Yeah.
Mhm.
All right. Well, listen, I want to wrap things up out of sensitivity, your time and everybody's time who joined us. So, in case you want to learn more about ARKK, ARKW, or ARKQ, you know how to reach Cathie and her website where they post trades and very transparent in what they're doing every day. For those of you that YCharts subscribers, you can come look at the depth of all kinds of things on the fund's holdings, everything else. Take that as a tear sheet. If you're an advisor and your client's coming and saying, "Can you tell me more about ARKQ?" Whole lot of information at your fingertips, and you can see the correlation between holdings, et cetera, et cetera. But I'll go back to where I started, which is Cathie. Thank you. It's just from a purely intellectual standpoint, it's amazingly informative to hear from visionaries about where the world's going in 5 years, 10 years, and 20 years. Um, the leap from there to boiling it down to cohesive themes is something very few people or organizations can do. But then to take the themes and say, well, how can these be investment opportunities is uh, a very difficult task. And I wanted to thank you. Um, you're not always right. Nobody's always right, but it's crystal clear to see how You're going from innovative themes to convergence to winner take most, et cetera, and how that leads to what you trade in, what you hold, and what you hold across your various funds.
Thank you so much, Sean. Your questions were great. Your research was great. Your service is great. So thank you so much.
Thank you. And for everybody who's on, again, I'll repeat the fact that this webinar will be posted on our YouTube channel, and everybody will receive a link tomorrow to the recording. So thank you. Thank you, Cathie. Thank you, everybody, for joining us.